Hello everyone, welcome to the third part of the inflation series. Now this video is a little heavy on data, but what you need to understand are the trends. You don't need to necessarily memorize any of the data, but just understand how the inflation has been moving in India over the years. So this is to give you some historical perspective on inflation. So initially in the 1950s, after independence, overall the inflation remained pretty low, less than 2%, but the volatility was very high. It varied from minus 12% to plus 13%. And this was because of various reasons. Won't get too much into that. But in 52 and 53, the agricultural production was very high, because of which the inflation was low. But as we industrialized, Nehru had this whole industrialization plan, because of which there was a high demand from industrialization, because of which the inflation shot up very, very high in 1956 to 57. So basically what I want to tell you is that whenever the agricultural production was high, the inflation was low. But when the industrialization was high and demand rose, the inflation became very high. So you can understand this as a period of volatility. Obviously it was a new country, we were trying to set things up, so everything was volatile, including the prices. But overall inflation was low. Okay, in 1960s was a very tumultuous period in the history of India. First of all, we had two wars in 52 and 62 and 65. Then there were famines in 65-66. So overall the inflation remained on a higher side, but the variation was lower because the inflation was high, around more than 5%. The variation was less than in the 50s. In 68-69 there was a bumper agricultural crop, because of which the inflation was the lowest in the decade of 60s. Again, don't need to remember all this, just remember that there were wars and famines, because of which the inflation was on a relatively higher side. Okay, in 1970s, as you can see, it is the first time that the inflation actually reached more than 20%. So overall in this decade, the inflation average was 10.3%. This happened because there were many supply shocks. There were agricultural supply shocks and there were oil prices rose a lot. As you can see in this, okay, we've written this in very cryptic manner. You can take your own note from this if you require, so that we wanted to give you as much information as possible in a condensed form. In 1974, the oil prices shot up by 250%. So obviously you can imagine that will have an impact on the prices in India. Like I said, it was the first time that inflation rose more than 20%. In 73-74, again you can see, because of the oil price shock, inflation was 20.2%. 74-75, inflation was 25%. So this is also the reason why there were a lot of political pressures in the country at that time, and lot of agitations which happened, because not only was there a lot of unemployment, because the prices were rising so dramatically that the common man was really under a lot of pressure. And also there was a lot of relatively fiscal deficit, and increasing money supply was happening, because of which the demand pressures were also there in the economy. All of this leading to the high inflation in the 1970s. Okay, 1980s, the inflation tempered down a little bit, but it was still pretty high at 7.2%. Okay, what was happening in this was, if you remember, or if you know, 1980s was a relatively high socialist kind of a period in the history of India. So what the government thinking was that, okay, we will nationalize relatively as much as we can. Government was getting into a lot of things. There was a lot of basically socialism kind of things happening. So because of which the government was spending a lot, which meant there was an expansionary fiscal policy. You just understand expansionary fiscal policy as basically government spending a lot of money. Now if the government spends money and it doesn't have, what will happen? Obviously you need to print more money, which is called monetization. So the RBI needed to monetize the fiscal deficits. So because of which the money supply increases in the economy and the prices rise. Also there were intermittent supply shocks. So because of both these factors, as you would see in the inflation video, the part 1, these are both supply and demand shocks, because of which the inflation rose. Fiscal deficit, as we've given, was approximately 6.8%, which is really high. Now you need to understand a vicious cycle that India got into. At that point of time, the government expenditure was rising, and the elasticity of government expenditure with respect to inflation was high. So which meant when the inflation rose, the government expenditure rose a lot, but the government receipts did not rise as much. This is basically because of the character of government expenditure at that point of time. So just understand, with rising inflation, the government expenditure rose a lot more than government receipts. So, but when the government expenditure is rising, again it will lead to higher inflation. With higher inflation, it will lead to further higher government expenditure, and all of this leads to higher fiscal deficit that needs to be monetized, and again higher inflation. So this is a vicious cycle that we got into. So higher government expenditure leading to higher inflation leading to higher government expenditure, leading to higher fiscal deficit, leading to monetization of fiscal deficit, leading to further higher inflation. So this is what was happening in the 1980s. Okay, from 90, then you know that we had the crisis of 91, and then we went in for liberalization. So what happened right after that? Between 92 and 96, inflation was again very high at 9.8%. The reasons for that were, first of all, there was depreciation. So rupee was devaluated. Now, as we've explained in various other videos, but again to reiterate the point, if rupee depreciates, if let us say rupee right now is $1 is equal to 50 rupees. If I import goods worth $1, it will cost me rupees 50. But if there is a depreciation and rupee now costs rupees 70, rupee costs 70 rupees for each dollar. If I import $1 worth of stuff, then I will be spending 70 rupees. So because of which, whenever there is a devaluation, the price of the imports increases. So this is the reason why inflation rose, and at that time we were importing a lot, which was the reason why we had the crisis in the first place. Secondly, there were MSP hikes, and there were supply-demand mismatches in pulses, oilseeds, edible oils, etc. So again, because of which the inflation rose. Fuel price rise, again, the most obvious culprit as always. There was a 13% rise in the fuel prices, because of which inflation rose. And there were a lot of capital inflows. Now, with the liberalization in the economy, there was sudden interest in India as an investment destination, and a lot of capital inflows did happen. So this also led to higher money supply, which led to higher inflation. Okay, then after that, for a long period, we saw a period of relatively low inflation, which is again why the common people have a lower tolerance towards inflation in India than in other countries. You might have read some reports where in other countries the inflation is much higher than the inflation in India, but even then there are more protests in India or more public opinion against inflation in India compared to those other countries. So this is the historical reason for that Indians, the current generation of Indians, have seen a relatively moderate phase of inflation between 96 and 2008, because of which they do not have a tolerance for a high inflation. Now the reasons for a relatively moderate inflation, the money supply was in line. So we checked our monetary policy, we imposed controls in terms of having a prudent monetary policy. So in line with inflation, the money supply was not allowed to go out of hand. Similarly, because of the reforms that were happening, there were improved monetary and fiscal interfaces. We removed a lot of crinks from the economy. A lot of constraints from the economy were removed. There were a lot of reforms in all kinds of markets, the government security markets, the share markets, the FDI market, because of which the transmission of policy happened and the inefficiencies were removed, because of which the inflation was contained. So I won't get into many of the technical points, but the RBI was also given autonomy, and because of which the sterilization was happening effectively. So basically, overall, you just need to understand that during this period there was a lot of policy transparency and policy, we can say efficiency, because of which the inflation remained at a relatively moderate level. But also you need to remember that during this time there were no global shocks in terms of oil prices or commodity prices which impacted India too much. So although we can take credit for reforming our policy and all, but it was also serendipity that the global parameters were also in our favor, because of which the inflation remained at a moderate level. Okay, now between 2008 and 2010, as you all know, the global financial crisis struck in 2008, leading to a volatility of all sorts, unprecedented volatility in the entire world, which also had its effect on inflation in India. So you can see in 2007-2008 in the graph, you can see the inflation was at a level of 4.7%, rising up to 8.1% in 2008-9. So you can see the inflation nearly doubled. But again it fell to a level of 3.8% in 2009-10. So you can see it's an inverted V. So as we have written, there was a high volatility during this period, and also inverted V. Why this happened was that once the crisis struck, initially all the global commodity prices went haywire and leading to a higher inflation. But then the overall global demand of everything just crashed because of the crisis, because of which obviously the prices in the entire world just bottomed out, and which also impacted prices in India, leading to a lower price as you can see in 2009-10. But after 2010, as you can see in this arrow, in December 2009 the inflation was at a level of 7.1%, rising to 10.9% within a span of 4 months up till April 2010. And after that, in 2010 and 11, inflation has remained in double digits. So again, we need to look at the factors which have been responsible. You will see the factors that have been responsible historically are also factors which are responsible now. So you can understand the underlying forces of inflation have not changed too much and have remained roughly the same. Again, you can see crude oil prices are the culprit. From $49 in 2009, they rose to $108 in 2011, obviously leading to a high price rise in India. Global commodity prices rose tremendously. One reason for this, apart from other reasons, is that because markets everywhere were crashing, economies were falling, lot of investors turned to metals and other commodities as safe havens for their investments. So a lot of this price rise was due to speculation in the commodity markets by investors. But nonetheless, the global commodity prices rose, leading to higher prices everywhere, including India. Rupee depreciated. Again, as I explained earlier in the video, rupee depreciation or devaluation always leads to higher inflation. Now, another thing which was specific to India was that the global crisis did not hit India as much as it hit the other countries. So our demand did not slow down as much. So because of which the demand side pressure remained. Also, we had schemes like MGNREGs. What that meant was that the rural economy never really fell to its feet. The rural economy was always up and about, leading to higher rural wages for the workers and therefore higher demand from them for food and other things. So our food demand never really went down because of the crisis. So leading to a higher demand side pressure in the economy. And also when now the Indians suddenly saw a period of high inflation, right from 2009 December onwards. So now the price expectations also started to rise. The people started thinking, well, it is very difficult for the government to contain the prices. There were various demonstrations against price rise. The government's one reason for the change of regime here was price rise. So people, the higher prices expectations settled in the minds of people, and they felt that the prices will not stabilize in a hurry. And also, even though I said that the country was not impacted that much by the global financial crisis, but it was impacted, and there was a stimulus announced by the government which led to higher fiscal deficits and also a loose monetary policy in terms of the stimulus, because of which the inflation again rose. So this is just to show you, the line in blue is the repo rate. So you can see the RBI adjusted itself to the price rise. The yellow graphs are the commodity prices, the WPI. You can see in April 2011, the WPI was very, very high. So you can see the repo rate also adjusted accordingly. It went to a high level of 8% in April 2012. But after that, the WPI has been decreasing, falling up to 0% in November 2014. But the repo rate has only now started to fall. This is because the RBI was always worried whether this the inflation fall is sustained or it is just a shock. So they did not want to cut rates prematurely, so they were waiting. So this just shows the picture over the years. In terms of inflation component, what I've tried to show here is, again, over the years, the blue one is primary articles and the yellow one is the food articles. So you can see that the prices of the primary articles and food articles has been high. We have explained earlier also that in India the supply side shocks were very, very present because of the global commodity prices and also global food prices. There were droughts in a lot of parts of the world, because of which the food prices were higher. So the inflation was high because of primary articles and food articles. Obviously fuel and power also playing its part, especially since 2012. But you can see the manufactured products, the inflation due to that was never very high, because the global slowdown, the Indian manufacturing sector also got impacted, and it wasn't very high because of this. Okay, absolutely recently in 2015, what has happened to inflation? The inflation in the economy has eased a lot. So inflationary pressures have been easing. There are various factors for that. One is there's been a global commodity price fall. So obviously the prices of commodities coming into India has also fallen. There's another video explaining that. Similarly, there's been a very dramatic oil price crash, again leading to lower inflation in India. So basically inflation has been reducing. The second point is that the government has assured to stick to the fiscal deficit target of 4.1%, which means it is saying that it'll try to have as much fiscal consolidation as possible. So how does fiscal deficit link with inflation? In very simple terms, fiscal deficit basically means that the government is spending more than it is earning. Now, if any person is spending more than it is earning, so he needs extra money. So the government, what it does in, again, layman terms, is basically it creates more money. So either it will go for, the RBI will have to monetize that debt, or whatever it does, it will basically lead to it's basically leading to more money in the economy. It will lead to a higher inflation. So if the government does stick to the fiscal deficit target, the RBI will be assured at that end that there will not be inflation from that side. Similarly, there's another theory in economics which says that inflations are affected by the inflationary expectations that economic agents hold. Because whatever expectations you hold, you will act in the same manner. So this is not exactly a very proper example, but just to still give you an example. If let us say I expect the prices to rise tomorrow. So I am a seller. What I will do, I will lead to hoarding. So I will not sell today. So effectively, even if the prices were not going to rise, what will happen is if everybody starts hoarding, the prices will rise. So there are various reasons, but if there are higher inflationary expectations in the economy, the economic agents behave in a manner which will lead to higher inflation. So there has been data to show that the household expectations are easing to single digits in terms of inflation. First of all, with the new government coming in, the people are expecting a lot of action to be taken on the economic front, because of which they feel the inflation will be falling. Similarly, when they see around them that the oil prices are coming down and commodity prices are coming down, again the inflationary expectations ease. So these are the reasons because of which the RBI has had elbow room to cut the rates, because the inflation has really been easing. So all of this resulted in a rate cut by RBI by 25 basis points. In this we try to cover the Indian inflation scenario over the years. Hope this gives you an insight into how inflation has moved and why inflation has moved the way it has moved. Thank you for watching. Hope you like the video. Comments and suggestions are welcome. Thank you.